welcome to Hilltop Wealth Advisors Economic and Market Update for the third quarter of 2025. I'm Ben Yeager here today with Chris Hostetler, and it's been an eventful first half to the year. There have been no shortage of client questions about the economy and the markets, and so today we're going to focus on answering several common questions. So Chris, let us start with one big question. Where is the economy headed, and should we expect a recession?
That's a big question. U.S. GDP started the year with a very slightly negative growth rate in the first quarter, but then improved to 3% growth for Q2. However, both of these figures were significantly impacted by dramatic swings in imports due to the threat of tariffs. Overall, economic growth slowed to an annualized 1.5% versus the prior year, and that's down from the stronger pace we saw in 2024. Consumer spending is cooling. The labor market is still healthy, but showing early signs of softening, and corporate earnings guidance has become much more cautious. So we've been calling this a cautiously cautious environment. The economy isn't contracting, but it's not accelerating either. And that raises the risk of stagflation, which is slower growth along with elevated prices. But we're not there yet, so it doesn't appear to be a recession. We've heard a few people call it the healthy tortoise economy, moving forward just slowly. So what about the other big economic story of 2025? Tariffs.
Yeah, that's a big story, and it's an ongoing one. Higher tariffs usually mean higher prices. They haven't fully hit consumers yet, but they're starting to. Inflation could push past 3% by the end of the year, and mostly because of these trade policies. So inflation and trade tensions are both risks. What else should we be thinking about, Chris?
Well, the Federal Reserve is another wild card. They're still holding rates steady after a few rate cuts last year, and that's because they're still concerned about inflation, but they are under a lot of political pressure to cut rates. At the most recent Fed meeting, 2 Fed governors dissented against the rate hold, and they wanted to lower rates. But this is the first time in decades that we've seen more than one Fed dissenter in one of these meetings. And it's important for the Fed to stay focused, because if they cave too quickly to this political pressure, that could shake market confidence.
Yeah, that's right. And Fed independence is key to market stability. And there's also concern around slower growth, especially in the third quarter, in a K-shaped economic expansion. So where wealthier households are still spending, but lower income households are really feeling the pinch. So the risks aren't hidden. They're really front and center, but they're also policy driven, which makes them hard to predict how markets will react.
Right. So the key, as always, is staying diversified and recognizing that the economy will continue to take twists and turns. So, Ben, we've covered the risks. What about the bright spots? Are there any real opportunities right now?
There definitely are. One of the biggest actually tied to a familiar theme, which you just mentioned. Diversification is working. For years, everything was very tech-heavy, U.S.-centric. Now we're really seeing international stocks, bonds, and alternatives making a real comeback.
Yeah, that's right. International equities are outperforming U.S. stocks by around 10 percentage points so far this year. That's a big shift, and it's being driven by a few things: a weaker dollar, strong earnings growth overseas, especially in Europe, Japan, and India, and policy changes that are boosting investments and productivity outside the U.S. So if someone's portfolio is concentrated in the largest U.S. tech stocks, it might be time to broaden the reach, right?
Definitely. Something to look at. Also, fixed income's looking attractive again. We're seeing core bond yields above 5% and even high yield over 7%. That's real income for the first time in a long time, which is particularly good news for retirees and really anybody who has a less aggressive allocation. One thing we'd like to point out, while consumer confidence is pretty low at the moment, we've seen the stock market returns often do pretty well during periods in years that these sentiment troughs, as we call them.
So the takeaway is, while the headlines may focus on slowing growth or rising tariffs, there's still plenty you can do as an investor. Stay balanced and global, and lean into quality and income. So given all of that, where are we finding opportunities?
Yeah, first we just mentioned international equities, which are benefiting from compelling valuations and a weaker dollar. And second, within U.S. equities, we're favoring large companies with global exposure with strong balance sheets as well. Third, bonds are back, as we mentioned last quarter, with yields near highest levels in over a decade, fixed income is finally offering meaningful income and diversification benefits again.
Here we're also doing some interesting things in what we call the specialty allocation of our portfolios. So in some accounts, we're adding a small direct allocation to a few of those large tech stocks. We often prefer a more diversified approach, but a few of those mega cap tech names appear significantly overvalued at the moment. So this direct approach allows us to avoid some stocks that could bring unnecessary risk. And yes, we just said you don't want to be overly concentrated in these very stocks, but we do still see opportunity for valuation growth in certain companies.
Plus, this gives us direct exposure to the AI growth trend, which is still driving earnings for a handful of large tech names. And second, owning individual stocks gives us more control when it comes to managing capital gains and losses, which is helpful for taxable accounts. And another thing is maintaining our exposure to the healthcare sector. Healthcare plays an important role. It helps diversify risk, and it also likely to benefit from AI, just in a different way. Think efficiency gains, better data use, and improved diagnostics, all of which can support long-term growth in the sector. On top of that, healthcare stocks are trading at a discount to their historic values.
So whether it's the targeted tech exposure or broader healthcare allocations, it's all part of a strategy that's meant to be both forward-looking and resilient. One last thing, we're hearing a lot of questions from clients on whether it's time to invest in cryptocurrency or blockchain investments. And while we aren't putting any client money into crypto right now, we do think it's a very interesting space that could potentially bring a lot of technological advancements in the coming years. And recent regulatory updates are bringing it more into the mainstream, which could remove some of that frontier or speculation risk that's long been a part of the crypto environment. So just know that we're keeping our eyes on that.
Well, we certainly covered a lot today, and hopefully we helped answer some of the bigger questions on your mind. However, if you have any other questions, please reach out to us. An advisor on our team would be more than happy to help. And if you found this helpful, please share it with your friends, family, colleagues. They likely have some of these same questions. And if you're not working with Hilltop already, we'd love to help you too. So visit hilltopwealthadvisors.com or scan this QR code to get started.
We'll see you next quarter.